Why do interest rate decisions matter for the economy? Have you ever wondered how the decisions made by central banks about interest rates can ripple through the economy? Interest rate decisions are fundamental because they affect borrowing costs, consumer spending, business investment, inflation, and overall economic growth. Central banks, through monetary policy, adjust interest rates to manage economic stability and growth. At a basic level, interest rates representing the cost of borrowing money and the reward for saving. When central banks lower interest rates, borrowing becomes cheaper. This encourages consumers to spend more and businesses to invest in expansion. For instance, lower mortgage rates can boost demand in housing markets, while cheaper loans can support business growth. On the flip side, when interest rates rise, borrowing becomes more expensive. This often leads to reduced spending and investment, which can slow economic growth and help control inflation. It is a balancing act that central banks must navigate carefully. From a broader economic perspective, interest rate changes serve as a policy tool to balance economic objectives. Lower rates can help combat recessionary pressures by encouraging demand. Conversely, higher rates can restrain excessive inflation by reducing demand. Unchecked inflation erodes purchasing power and can destabilize the economy, while too low inflation or deflation can hinder growth. Interest rate decisions also impact how people save. Higher rates make saving more attractive by offering better returns. This can reduce immediate consumption but increase future investment capital. In contrast, lower rates discourage saving and boost spending. Moreover, interest rates have implications for government finances. Higher rates increase the cost of servicing public debt, which can lead to larger budget deficits and influence fiscal policy decisions. They also affect currency values. For example, higher rates can strengthen a country's currency, making exports more expensive and less competitive internationally. In practical terms, interest rate decisions send signals to markets and economic agents about the central bank's outlook on the economy. These signals influence expectations for inflation, growth, and financial stability, which in turn affect investment decisions and financial market behavior. Interest rate decisions matter because they directly influence economic activity by affecting borrowing and saving incentives, controlling inflation, guiding government fiscal conditions, and shaping market expectations. These effects ripple through the economy, making interest rates a key lever in macroeconomic management.